today we are going to be talking about qualifying for a mortgage when you're self-employed, what's involved, what are the challenges, and some options that might help us to boost your qualification a little bit higher. And then we're also going to end with some talk about mortgage rates and where mortgage rates are right now. If you're self-employed, of course, like everybody, you want to pay as little tax as possible. So naturally, you're going to try to write off as much as you possibly can off your taxes to get your income down as low as you can. The less your income, of course, the less tax you pay, and the goal is to get that income down low so we pay as little tax as possible. Now, this is great when it comes to taxes, but not so good when it comes to qualifying for a mortgage. A lot of people, let's say you're incorporated, may make a lot more money, the corporation may make a lot more money, but you want to pay yourself as low as possible to keep as much money in that corporation, again, so you pay as little as little personal tax as you possibly can. Now, this can create a challenge when qualifying for a mortgage because lenders don't look at your corporate earnings. They look at your corporation as a separate entity. Even if you're the sole shareholder of the corporation, they look at it as a separate entity. They generally do not look at the income the corporation is earning. They look at what you are earning personally. So it really doesn't matter how much the company is making. Now, there are some exceptions, which we're going to talk about shortly. So let's look at what lenders do look at when they're qualifying and how they determine the maximum income that they can use for you. Now, whenever we have a client complete a mortgage application, they're self-employed, they'll always put in an income. Usually it'll be whatever they paid themselves the previous year. In some cases, we may be able to use more than that. In other cases, it may be less. Really depends on the situation, but we're going to go into that in a little bit of detail now. So when you're self-employed, lenders are going to ask you for a few different documents. They're going to ask you for your last 2 year's T1 generals. Those are your tax returns. Now, what is required is your full and complete tax returns, no summaries or condensed versions. They want to see the whole thing. Because sometimes it's not just the key numbers that they're looking at. They're going to go through everything else on that return as well to make sure that everything is in line. Sometimes it's not what they want to see, it's what they don't want to see. They don't want to see something like, well, let's say, for example, you have a rental property disclosed on the tax return and it is not on the application. Well, that's going to lead to questions about that property because that has to be factored in. So they're going to ask for your last year's T1 generals. They're going to ask for your last year's notice of assessments. That's primarily to verify the information that is on the T1, as well as to confirm that there are no taxes owing. If there are taxes owing on your last notice of assessment, then the lender will want to see those taxes paid prior to closing of the new mortgage. So really important. Now, if you're incorporated, they're also going to ask you for your articles of incorporation. If you're a sole proprietor or in a partnership, they'll want to see a business license, and they will ask for your financial statements as well if you're incorporated, last year's financial statements to show that the business is in good health. Now, what do lenders use these documents for? What are they looking at? How are they determining your income? Lenders are going to look at whether you are a sole proprietor, a partnership, or a corporation. They are going to look at a 2-year history. So they're only going to go back 2 years. They're going to ask for the 2-year history of these documents. That's why these documents are required for the last 2 years, so they can come up with that amount. And they will use an average of those last 2 years, providing that the income is increasing year over year. Now, if it's declining, if the most recent year is at a lower amount than the previous year, then they will go with that lower amount. Now, if you are a sole proprietor or if you're in a partnership, then they're going to look at your line 13,500, 13500. A few years ago, CRA thought it would be fun to add a couple of extra zeros to that number. So it used to be just the line 135. Now it's 13500. So don't ask me. Just an extra layer of complexity that doesn't seem to really serve much purpose, but I'm sure they've got their reason for it. Just doesn't seem to make a lot of sense. So for simplicity in this video, we're going to knock off those extra 2 zeros, and we're just going to call it the line 135, as well as other line numbers that we're going to discuss during this video. So if you're a sole proprietor in a partnership, they're going to look at that line 135, and they're going to take a 2-year average of that. Now, most lenders will allow us to gross up that income by 15%. So we can come up with a little bit of a higher income than what you're actually reporting, which can help out in a lot of cases. That can mean the difference between qualifying for the home you want versus not qualifying at all, or having to accept a less desirable property. So that's if you're in a partnership or if you're a sole proprietor. Now, if you're in a corporation, then they're going to look at lines 101, which is your employment income, and they're going to look at line 120, which is what you paid yourself in dividends. They're going to look at both those lines. Now, in some cases, you may pay yourself a salary from your corporation. That's going to report on line 101. If you also take dividends, then that will report on line 120. So they're going to look at both those numbers, and they're going to take an average of the last 2 years, again, providing they are increasing, the income is increasing year over year. Now, most lenders will not allow any kind of gross up here because tax write-offs are generally put through the corporation. They're paid through the corporation when you are incorporated, so they generally don't gross up. Now, there are some lenders who will gross up your line 101 only, but that is not all. We would, of course, review your application, see what you're looking to buy, see what your price range is, and then see if we need to look at any kind of alternative options to get you into what you want. Now, another line number on your T1 General is your line 150. Now, line 150, that is a total of all your income combined. It'll include your line 101, your line 120, any other lines where you have income coming in. Lenders generally do not look at this number because it has other incomes that may not be usable. For example, if you made an RRSP withdrawal, that's going to show as income, and that's going to boost your line 150, but that is not usable because it's not sustainable. Same with capital gains. Any capital gains income is also going to report on that line 150, and capital gains, once again, unless it's sustainable, it cannot be used towards your income. So they restrict it to the line 101 and the line 120, and that is the basics of how they look at your income. Now, what happens if your income is too low and you don't qualify for what you're looking for? Well, there are some lenders who will look at your financial statements, your corporate financial statements, and they'll look at the net income after taxes. And they'll generally use between 40 to 60% of that number less the dividends that you paid yourself. So this shows extra income left in the corporation that the lender will look at. Now, sounds good in theory, but in a lot of cases, that may not get to what you need, in which case we would look to see if you have adequate net worth and qualify you under a net worth program. So a net worth program is where it's not so much the income, but it's based on how much liquid assets you have in financial assets, such as RRSPs. If we're using an RRSP for that, lenders will discount that by 30% because you haven't paid tax on it yet. Checking account, savings account, they use the full amount. Lenders are generally looking for a minimum of $250,000 in assets over and above your down payment. So if your down payment is coming from that, then that cannot be counted towards your net worth because it's no longer a liquidatable asset. So lenders are only going to look at the financial assets that you're going to have after closing. Now, some lenders will only look at the last month. Other lenders are going to take the lowest balance that you have on all your financial accounts over the past year. They'll go with the lowest balance for that period. So there's many different lenders who offer a net worth program. Most of them are the big banks, and you might have the odd other lender offering them, but it's mostly going to be the big banks here. And then how the net worth program works is for every $1 that you go over your maximum qualifying limits, you would need $1 in additional net worth. So for example, if you qualified for a certain amount and you need to qualify for, let's say, an extra $100,000, then you need to have an extra $100,000 to support that higher purchase price. And net worth programs can get a little complex at times, so we would review your situation, of course, in detail and advise you on what you'd be eligible for based on that. Now, the third option is to go with an alternative lender. Actually, before we go on to alternative lenders, just take one step back. For the net worth programs, it is possible in some cases to buy with as little as 20% down, but to really unlock the true power of the net worth program, you need to have a down payment of 35% or 35% equity in the property if we're refinancing. Okay, now moving on to alternative lenders, also known as B lenders. Their focus is on people who do not qualify through traditional sources such as the big bank. So anyone who can walk into any bank, if they walk into any bank and qualify, they would go with an A lender. A lenders being the big banks, major credit unions like Alterna, Meridian, Duca, First National, MCAP, MCAN, Merix. These are all examples of A lenders because they cater to people with qualifying credit and qualifying income. So if you don't fall into that bucket, that's where we go to the B lenders or alternative lenders. And with alternative lenders, the minimum down payment is always 20%. They will charge a 1% lender fee. That's 1% of the mortgage amount. And they will also charge you a higher rate than what A lenders are offering as well. So it is more expensive to qualify through a B lender. However, it could be the difference between getting the home that you really love versus qualifying for one that is just okay or not qualifying at all. So B lenders will look at your corporate assets. They'll look at your corporate bank statements. They'll generally ask for either 6 or 12 months of bank statements, and they will come up with a usable income based on deposits into that account, whether it be a corporate account or a personal business account. It's very similar. They're going to look at the money coming into the corporation. They're going to look at whatever expenses you have, and they're going to come up with a usable income for you based on that. And often you can qualify for substantially more than what you would qualify for through a traditional A lender. There is a lot of working parts, a lot of moving parts here with mortgages. So if you are self-employed and you're interested in finding out how much you qualify for, if you're serious about purchasing something soon, then reach out to us and we will let you know exactly what you'll qualify for based on your particular situation. Now, lowest rates today, this is the fun part. Everybody loves hearing about rates. The lowest 3-year fix for an insured mortgage is still as low as 3.84%, up to 4.09% for an uninsured, and could be in between as well. So we have different options there. If you are looking for a 5-year fixed, the rate ranges from 4.04 to 4.24. Now, this is up from 3.89 where it was last week. For those who watch my videos regularly, you would have heard me talking about these promos that are ending soon, and they have now ended. They ended July 31st, so now the lowest rate there is a little bit higher. The lowest variable rate ranges from prime minus 1.05 for an insured mortgage or some uninsured, depending on the situation. That could get quite complex, to prime minus 0.75, which is 3.7. So in the range of 3.4 to 3.7. Now at PMT Mortgage, we are always going to get you the lowest rate that you're eligible for. This is something that we take very seriously. We are always combing markets for our clients, trying to find them the absolute lowest rates out there. The top 3 lenders that we deal with each year can vary because it really depends on who's putting their best foot forward. Yes, we believe in lender relationships. They're important to us, but we also believe in getting you the absolute lowest rate that we can. So our lender partners have to come forward and give us something competitive if they want us to send your business to them. So we are very serious about that. We are always combing the market, looking for lenders with lower rates. And we do this right up until your closing date. So let's say you've purchased something, you've got a closing a few months down the road, we'll get you approved at a certain rate. That guarantees you that that rate will not be higher than that. but we are still watching the market for you. If we can get that rate lowered for you, we will, either with the same lender or we'll move you to a different lender if we have to. But we will get you the absolute lowest rate that you're eligible for. That's about everything I have to say today. If anybody has a purchase closing within 120 days or a mortgage coming up for renewal within 120 days, please reach out to us at info@pmtmortgage.ca. That's short for Paul Meredith Team. And you can also call us the old-fashioned way, 647-368-5009. I write a blog every Wednesday. Check that out at easy123mortgage.ca/blog.